Hi, I'm Chris Cebula, and I'm here with Mark Armbruster. Welcome to this episode of Armbruster Capital Management's Invest Ed VidCast series. Today, we're talking about valuations and speculative excess.
Indeed. It seems like a whole new world out there for investors. We keep hearing about things like SPACs, NFTs, cryptocurrencies, short squeezing, meme stocks, and other new ideas that are becoming a normal part of the investment vernacular. These are mostly highly risky. I want to call them investments, but they're not really. They're more speculative vehicles and strategies. Ironically, while trading things like SPACs, NFTs, and cryptocurrencies is becoming more commonplace, most people trading them probably don't really understand how they work or the risks that they pose. However, that doesn't seem to stop anyone. There's a healthy appetite for risky trading these days without much regard to possible losses. And so, what do you think, Chris? Why is this happening?
I think there are a number of reasons. A long period without any significant losses bolsters confidence. Perhaps people are restless after being cooped up in quarantine for a year and looking for an outlet. And certainly today's loose monetary policy and the explosion of liquidity in the economy has the markets roaring. I think what is more interesting, and perhaps troubling, is the fact that this phenomenon is not limited to new, more esoteric investments. Even more mundane investments are now trading at what seem to be crazy levels.
So I'm familiar with the nosebleed multiples in the technology sector. Can you give us an example of sort of a more mundane stock that's trading at crazy levels?
Sure, WD40 is a great one.
The spray lubrication company?
Yeah, everyone knows WD40, and you likely have a bottle of it somewhere in your house. What many might not know is that WD40 is actually a publicly traded company and has been for many years. Also, not surprisingly, is that it is a relatively boring company. The vast majority of its sales come from just one product, WD40. Interestingly, though, the main use is not from customers like you and I, but from manufacturers using it as an industrial lubricant.
I would think that demand for something like that would be pretty stable. I would think that would make its financials pretty consistent through time. Maybe it grows in line with overall GDP.
Yeah, that's right. Looking at their most recent annual 10K filing with the SEC, you do indeed see consistent and stable revenue and earnings over the last 5 years. Again, a bit boring, but nice and predictable.
What seems less predictable is its stock price. The chart shows a big run-up over the past 6 months. What happened there?
Well, that's the funny part. Nothing seems to have happened. The company appears to be chugging along the same way it always has, with consistent revenue and earnings, but without any huge new initiatives or growth plans. It's not like they haven't released the WD41, acquired any new companies, even converted their balance sheet to Bitcoin. They didn't release a new app or even rebrand themselves to using only organic ingredients. They are likely to benefit, as you mentioned, from overall GDP growth and some of the COVID home renovation boom, but not enough to materially change long-term demand.
So why are people suddenly willing to pay so much more for the shares?
Well, it's likely the same reasons we discussed for the popularity of SPACs and cryptos. More money in circulation, low interest rates, and speculative fever in the markets.
It looks like the price-earnings ratio is close to 50 times. That's pretty high for a company that's just growing with the economy.
Right. It trades at a higher multiple than Apple, and at a significant premium to the rest of the overall market. If you think this through, it'll take almost 50 years of earnings to recoup your purchase price. While WD40 is a great company, that price does seem to be a bit irrational.
Warren Buffett preaches the merits of value investing by buying good companies at good prices. Here, it seems we only have half the equation. A good company, but not such a great price.
Yes. With all the news of new and interesting investment vehicles and products, we seem to be losing sight of investment fundamentals throughout the market. This is certainly another sign of bubble-like behavior.
Yeah, we discussed this before on one of our vidcasts, and there's even some market gurus like Jeremy Grantham who are saying the markets are in bubble territory currently.
Yeah, bubble or not, there certainly is elevated risk for investors today.
Historically, that has always come home to roost in unpleasant ways, and I suspect the same will be true this time. However, irrational markets can continue for some time, so it may be that SPACs, NFTs, cryptos, and even industrial lubricant company stocks continue to rise.
Possibly. And we all know it can be hard to sit on the sidelines of these events while others are making money. But if you ask me, I'd rather stick with my long-term diversified portfolio. It may be boring, but I know it will work out over time and save me a lot of anguish when the next downturn comes. Thank you for joining us on this episode of Armbruster Capital's Invest Ed VidCast series. If you want to talk further about speculative excess, market valuations, or even cryptocurrencies, please reach out to us anytime.